Hello, everybody. My name is Adam Bergman, and this, of course, is The Adam Bergman Show. Thank you so much for tuning in. I greatly appreciate it. Did you know that according to a recent survey, 1/3 of Americans do not have a retirement account? And of the ones that do, over 50% did an early withdrawal from those retirement accounts. And in another recent survey, it shows that 23% of Americans do not have a tax financial plan. A tax plan is the analysis of one's financial situation and putting it all together in order to maximize your tax efficiency and to make sure that you pay the least amount of taxes as legally possible. In this video, I intend to cover several tax strategies that I personally use in my every single day life. These strategies will cover you if you are employed by a corporation, if you are self-employed, or if you are both. How are you both? Well, you're working for a company and you started a side hustle, or you're working for a company and your side hustle is beginning to flourish and grow into a side business. This video is for anybody that wants to legally increase take-home income, reduce taxable gains, and plan for you and your family's financial future. This video is for both traditional finance, crypto finance, and personal finance maximization. And of course, I can't start without saying all of this is purely entertainment and for educational purposes only. None of this is facts and none of this is advice. As I am not a CPA, I am most definitely not a financial planner. However, this video is most definitely brought to you in partnership with 1-800-ACCOUNTANT. 1-800-ACCOUNTANT is a superb firm that is licensed in all 50 states that can help you navigate all your tax questions and prepare for a great tax strategy for you and your family. I definitely urge you to click the link down below in my description. My partners, 1-800-ACCOUNTANT, make sure to give a free consultation for everybody that's sent from the Berg. And they won't give you any special treatment just because I sent you. However, they will give you the same treatment as they give everybody else. And that's A+ 5-star treatment. So don't waste any more time and call 1-800-ACCOUNTANT today. Today, I plan to talk about 3 key strategies in taxes. Number 1 is retirement accounts. Number 2 is offsetting your capital gains. And number 3 is how to turn your hobby into a money-making, tax-deducting monster. The first retirement account that I want to talk about is called a 401k. There are 2 versions of a 401k, a traditional 401k or a Roth 401k. Depending on which one you open, you can have a tax benefit on the front end or on the back end. I will talk a little bit more in depth about this in the next section of this video. There is a maximum contribution as of 2022 of $20,500 that you can personally contribute as the employee. The reasons for a 401k is simple. Your employer offers this plan to you as an employee. A lot of employers, they do something called a match, which means if you invest a certain amount into your 401k or into your future, your employer will either match the entire sum, a partial sum, or even an added sum. Although the maximum contribution that you can do as an employee is $20,500, the maximum total contribution that could be done between you and your employer is $61,000 in total. Now, I never worked for anybody that would match me to $61,000, but who knows? I guess some people have amazing employers. The benefit of this account is it's either tax deferred in the front end or tax deferred in the back end. However, in both instances, you can't touch the funds until you're retired. The retirement age is considered 59 and a half. And when you do take out your money, you're either paying no taxes or you're paying taxes at a reduced tax bracket. The benefit of a 401k is you can open up an account and you can invest in ETFs, which stands for Exchange Traded Funds. Normally in a 401k, you invest in a fund and not an individual stock. However, your value of this 401k account appreciates over time as the assets grow. And since you're not paying taxes the entire time, that allows your assets to grow that much stronger. The next retirement account I would like to talk about is called a Roth IRA. An IRA stands for Individual Retirement Account. A Roth IRA has tax benefits at the back end and not at the front end. What does that mean? You cannot deduct the amount that you're putting into your Roth IRA from your actual taxes that you pay, which means the amount you make at the end of the year is the amount that you have to pay taxes on. The benefit of a Roth IRA is once you actually retire and you can take out your funds again at 59 and 1/2 years, you wouldn't have to pay any taxes at all. As opposed to a 401k, whatever you put into your account gets deducted from the total amount of salary that you made in the year, and it gives you an upfront tax deduction. But you do have to pay taxes on the gains earned up until that 59 and a half where you withdraw your funds. With a Roth IRA, you do not get a tax deduction off of the income that you made for the entire year. However, when you do withdraw the funds from a Roth IRA, you get the benefit of paying $0 on all the gains made throughout the years. And again, since you're not paying taxes on every single trade, that means that at the end, at 59 and a half, when you withdraw your funds, the accumulation power is maximized to its full potential. In order to invest in a Roth IRA, you need to be making $129,000 and less. If you are making more than $129,000, you do not apply for a Roth IRA benefit. And if you are investing in a Roth IRA, there are limits to the contribution amounts that you're allowed to do. The maximum contribution amount, if you are 50 years and less, is $6,000. However, if you are above 50 years old, you can now contribute an added $1,000 to make it an even $7,000. One of the added benefits to a Roth IRA is you do not have to invest in an ETF, which is an exchange traded fund like a 401k. You have maximum control over your account. You open up a regular brokerage account and you can buy whatever you'd like, which includes ETFs, but you can also buy individual stocks. Well, now somebody's gonna say, Adam, a Roth IRA is fantastic, but I make $150,000 a year, or I make $130,000 a year. It's not fair. Just because I make an extra $1,000, I don't qualify for this Roth IRA deduction on the back end. That's not fair. To you, my friend, I'm gonna say you actually have a lifeline. You see, there's something called a backdoor Roth IRA. A backdoor Roth IRA is still in play, and I will explain to you exactly the power of a backdoor Roth IRA. But keep in mind, our president, Mr. President Joe Biden, is trying to do away with backdoor Roth IRAs in his Build It Back Better plan. However, since the Build It Back Better plan did not pass, we still have options for a backdoor Roth IRA. This is actually one of the IRAs that I actually can qualify for because I can't get a regular Roth IRA because of my income. A backdoor Roth IRA means that you're going to open up something called a traditional IRA. When you open up a traditional individual retirement account, you got to see your income level. If your income level is above $129,000 threshold, that means that you don't get any added tax deductions on the front end. If it is under, then you get the tax deductions. But we're not concerned if you're under $129,000. We're concerned if you make over $129,000 and you still want the added benefits of a Roth IRA. If you want those added benefits, you open up your traditional IRA and then you do something called a rollover to a Roth IRA. And now you get all the added benefits of a Roth IRA. And I highly encourage you guys to seek a consultation with 1-800-ACCOUNTANT. I have a link down below in the description. These guys are absolutely awesome and giving out free consultations. Free is free. If anything that I'm saying today, and I got a lot more information, is a little bit overwhelming, but it actually does give you some type of inclination in your mind. And you're like, wow, I could actually be making a lot more money and my financial life has so much more potential. And then I urge you to give yourself as much potential as you can and click the link down below to 1-800-ACCOUNTANT. I have a lot of subscribers that linked up with 1-800-ACCOUNTANT, and all I hear is great reviews firsthand from people that I talk to on a daily basis. So far, I have not had a single complaint. So do yourself a favor and click the link down below. Get your free consultation today with 1-800-ACCOUNTANT. Next on the list of IRAs is called a Sep Ira. A Sep Ira is specifically for the people that have their own business. They don't work for anybody and nobody's taking care of you, so you have to take care of yourself. A Sep Ira is tax deferred on the front end, which means whatever you invest in the Sep is not taxed at the end of the year, and it's deferred until when you retire at 59 and a half years old. The rules for a Sep Ira say you have a maximum contribution of $61,000 or 25% of your employee's compensation, which means 25% of your salary. Real quick, if you pay yourself $100,000 in your bank account at the end of the year, you have $150,000. That means 25,000, right? 25% of the 100,000 that you pay yourself, you can put into a Sep Ira, which means that the balance of your income or the balance of your company's liquidity is no longer 50,000, it is now 25,000, which means that the taxes that you pay as a distribution would only be on 25,000 as opposed to 50,000. And you're investing into your retirement even though you own your own personal business. Some of the added benefits of a Sep Ira is you control your account very much like a Roth IRA. You are not limited to only ETFs, exchange traded funds. You can invest in any stock that you prefer. Before I go any further, I just wanted to tell you, if all of this sounds insane, I will be giving you some mathematical examples at the end of this video and show you guys exactly how this makes sense and actual numbers of how much you would be saving if you're opening up these different type of accounts. The next account that I would like to talk about is called an HSA, or a health savings account. This is one of the best, if not the best, type of accounts you could possibly do. Why? This is something called triple tax deferred. Why is it triple tax deferred? Your contributions reduce your total taxable income. Any investment growth that you have in your account, any gains that you have are actually tax-free, and any qualified withdrawals that you do, for example, anything to do with healthcare, is also tax-free. The only caveat of this, you must have a high deductible insurance plan. Whether this is offered to you through your employer or this is offered to you as your own personal insurance if you own your own business. The maximum contribution as a single person is $3,650 as of today, 2022. However, if you are a family, the maximum contribution is $7,300. When you open up an account, it can be just a regular savings account or it can be a brokerage account where you can actually trade. Some of the key brokerage accounts or some of the most popular brokerage accounts that you can open up are Lively, Fidelity, and Bank of America. However, this is not the total limitations, and there are others that offer these type of accounts. I'm just giving you the top 3 that I know of. I will leave a link down below to all of these, and you could just open up your own account. This is not a referral link. I don't get anything from it. I just want to make it as easy as possible for you guys to understand where and what and how you can invest. If you are offered an HSA from your employer, they will already have a third party that they open up accounts for you. If they don't, then you just pick whichever account you want. What are the key benefits to an HSA? An HSA is a health savings account, correct? But you don't have to use the money for health. In other words, if you invest into this account, you can use it as an every single day brokerage account. The benefits are on the front end, you can tax deduct the amount of money that you're contributing to your HSA. On the back end, when you actually retire at that 59 and a half years old, everything that you gained, all your gains are tax-free. So now you have a bonus of works like a Roth IRA, and it works like a 401k or a Sep Ira. And the third tax benefit is if you actually use the money for your health, for doctor's visits, for prescriptions, for the eye doctor, so on and so forth, that's also tax deductible. A lot of people choose not to use their HSA funds and they just pay out of pocket when they go to the doctor because of the added tax benefits. The whole point of this account though is if you do go to the doctor, I'll give you an example, and you have $100 that you need to pay the doctor, you have a doctor's bill of $100. If you are paying out of your pocket, that means that you were already taxed for that $100. So that means that $100 was actually approximately $124, right? Because if you're at a 24% tax bracket or a 22% tax bracket approximately, that $120 or so now becomes $100. So in order for you to spend $100 out of your pocket, you actually had to earn approximately $120, $125. If you do it through an HSA, you take literally $100. It's not 125, you take 100. You just take it from your salary and you put it into this HSA account. Now, when you pay for your medical bills, that $100 is actually $100. Do you understand how powerful this account is? And if you don't want to use it for your medical bills, you roll it over every single year and you build it up like a regular retirement account. Remember what I just told you. 1/3 of all Americans do not have a retirement account, and 23% of Americans do not have a tax financial plan. I guarantee you all 23% of those Americans do not watch The Adam Bergman Show. While we're on the topic, do me a favor, 2 things. Please, for me, give me the like, shares, and subscribe while you're at it if you like this type of content. And 2, click the link down below and do yourself a favor and contact 1-800-ACCOUNTANT. I know I keep talking about them, but a lot of the things I'm telling you is just the basics. It's basics for me, but it could be super complicated and over a lot of people's heads. So please do yourself a favor and get your financial future planned. Work for retirement. Make sure that you and your family are set. Don't be like most Americans that have no idea what's happening, and when the time comes, you are not prepared. The best way to prepare is to contact a licensed CPA, and some of the best CPAs throughout all 50 states in this country is 1-800-ACCOUNTANT. So do yourself that favor, do your family a favor, and click the link down below for your free consultation with 1-800-ACCOUNTANT. Now that we covered individual retirement accounts, I want to talk about the next strategy called capital gains. When talking about capital gains, that is the amount of money that you made on your investment, whether it be real estate, whether it be crypto, whether it be stocks, and there's a bunch of other investments that you can make, like a business, precious metal, stamps, so on and so forth. When talking about capital gains, there's 2 categories for capital gains: short-term capital gains or long-term capital gains. Short-term capital gains means you held something for 365 days or less, while long-term capital gains means that you held something for 366 days or more. What is the key differences? The key difference is if you hold it for short-term capital gains, you are taxed on your regular tax bracket. However, if you hold for long-term capital gains, you get a reduced tax bracket of 15% in most cases. Unless you're making an ultra big hit, I believe the threshold is 450,000 or so, well now your tax bracket is not 15% for long-term capital gains, it's gonna be 20%. And don't forget, if you make more than $140,000 between your capital gains and your income, you now are gonna be paying that 3.8% Obama tax in addition to that 15% that I was just talking about, or the 20% if you made over that 450,000 or so. But if you do want to quote somebody, contact 1-800-ACCOUNTANT. Now, when talking about capital gains, it's very important to understand how to play the game. There is something called tax loss harvesting, and then there's something called a wash rule. Tax loss harvesting is the ability to offset paper gains or paper losses against realized gains and realized losses, and do it in a strategic type of way. In addition, there's something called a wash rule. A wash rule applies for stocks, but does not apply for cryptocurrency. Thank God, Build It Back Better plan was not approved. Wash rule means that in order for you to take those deductions, you cannot rebuy whatever you just sold for 32 days. That means on the 32nd day, feel free to rebuy. You need to wait 1 month. With cryptocurrency, there is no such rule, which means that you can buy and sell within a minute and you get those tax loss harvesting benefits. I'm about to give you my own personal example. This is not all of my finances. I'm just gonna give you one such example. And this is not to brag or boast. I'm doing this to show you the absolutely massive power of tax loss harvesting if you do this correctly. This is just one of my stock accounts. As you can see, I invested around $705,000. This is for 2021 in this specific account only. That $705,000 was able to grow to around $985,000. As you can see in my net gain or loss, I have a gain of $281,977, which means that I have to pay taxes on that. And between city and state taxes and federal taxes and Obamacare taxes and all of that put together, I would probably be paying around 50% taxes on that 280 grand, which means 280,000 would only be $140,000 in my pocket. And that sucks. So what did I do? I did a crafty tax move called tax loss harvesting. Towards the end of 2021, stock markets weren't doing so good and crypto markets were not doing so good. I invest in a lot of crypto. What I did is I was at a huge loss for cryptocurrency. This is my account from Coinbase. As you can see, I was able to swap out some of my cryptos, and all I did was Cardano for Algorand, Algorand for Polkadot, Polkadot for Bitcoin. And by doing this, I paid almost no fees to Coinbase for the swaps. If you sell, there is a fee. And when I did this, I was able to realize my paper losses of almost 90,000 into realized losses of 90,000, which means by taking this loss, I now reduce my gains from 280,000 or so to $190,000, which means that I'm only gonna have to pay taxes on $190,000 as opposed to $280,000, which means that I only have to pay around $95,000 in taxes as opposed to $140,000 in taxes, which means just by a few minutes of work, I was able to save around $55,000 in realized gains by doing literally what the tax code tells us we should do and what we're allowed to do. Now, this is just one example of the plays that I did this last year. Besides for that, I was very crafty with what I sold and bought. I was able to sell my stocks in my personal account and rebuy them in my Sep account. And by doing this, I was able to add more realized losses, and this also drastically reduced my tax bill. At the end of the day, the tax law is actual laws, it's words, and it's here to help you reduce the amount of taxes you have to pay legally, but it don't help you unless you help yourself. And in order to help yourself, and if you want these fire plays where in just a couple of minutes you can save yourself tens of thousands and hundreds and thousands of dollars, do yourself a favor and click the link down below to 1-800-ACCOUNTANT. If you like the fire that I'm spitting today, they're gonna absolutely rock your world with the total amount of information that they have. Licensed in all 50 states, ready to help you do your taxes and do financial tax planning, which leads me to the final chapter of this video. What is the difference between poor people and rich people? Poor people are said to have hobbies, which means extracurricular or recreational activities, while rich and wealthy people have a tendency to have companies but never hobbies. What does that mean? And I'll give you a specific example. You have something that you like to do, figure out a way to turn that into a business so that you guessed it, you have additional tax deductions. Let's say, for example, you are an NFT artist in the crypto world. You are starting an NFT business. Well, if that was me, I would open up a business, just like I opened up a business for my YouTube. A lot of YouTubers do not open up businesses, and it boggles my mind how a financial YouTuber talking about finance does not understand the basics of opening up a corporation to help you out and plan for maximized tax efficiency. By opening up a business For an NFT, for example, you get deductions. What are the deductions? Anything that has to do with the business. For example, you have an apartment, you have a home. Part of that is used as a home office, right? You're creating your NFTs. That is tax deductible. Some of your utilities, tax deductible. Your computer, tax deductible. Adobe Suite, tax deductible. Gas needed for business-related driving, tax deductible. If you need to go meet up with a client in a different state and you got to pay a toll, tax deductible. So on and so forth. There are tons of legal tax deductions. A lot of people would say, well, Adam, I don't make any money yet. And to this, I would say, that's fine. But the reason you're doing this is to increase your net worth, to make money in the future. What happens is, if you invest into your business, let's say you have $5,000 and you're using that $5,000 to build your business, whatever business it is, NFTs or something else. You take the $5,000, you open up a business account, you put the $5,000 into your business account. You use that same $5,000 that you would be using to build your business or your side hustle, but do it from a business. Now, any income that comes in, any income that's generated, you can offset that initial investment. Once you actually make money, you pull out your initial investment and now you can actually make money from income. The losses that you're generating this entire time can be pushed forward 80% of your net losses indefinitely, which means eventually, let's say you invest your money and you're taking losses. Over time, you will start making money. Let's say in 4 or 5 years from now, you're making a huge business and you're making $100,000 a year. Well, every single year you're deducting $4,000, $3,000, $2,000, so on and so forth. That offsets against the actual income that you're generating in your business. Don't think the small game, think the long game. This has everything to do with your retirement, your family, maximizing your efficiency and maximizing the income that you're generating. There's several ways to maximize your income. There's actually making more money, right? You made $100,000, now you're making $110,000. But the other way of maximizing your income is by reducing the amount that you give back or reducing the amount taken away from you. How do you do that? With a tax strategy that works by actually reducing the amount of taxes that you have to pay. And the first step is click the like, share, and subscribe, but also hit the link down below for 1-800-ACCOUNTANT. Again, they're going to break all of this down into plain English. They are a fantastic firm offering services in all 50 states. If you need to see their credentials, I do have a link down below where I did a live AMA with now their CFO, their Chief Financial Officer, Greg. At the time, he was a senior accountant. Greg got promoted. Congratulations to Greg. In the final part of this video, and I know it was long, I want to give you guys 2 examples of how you can actually save money. In the first example, somebody is making a $100,000 salary. They have a 401k option. On a $100,000 salary, your federal income tax would be 24%, which means on $100,000, you would pay $24,000, which leaves you with $76,000 after paying your tax. Well, let's say you want to contribute into your retirement account and you're like, well, I want to contribute $10,000. Now you take $10,000, you deposit into your 401k. The $10,000 is deducted upfront against your actual income, your actual earnings. So now you take $100,000, you minus $10,000, you're left with $90,000. On $90,000 at a 24% tax bracket, you would be paying $21,600. Before, you would be paying $24,000. Now you're paying $21,600. You were able to save yourself $2,400 in tax payments by taking advantage of a 401k contribution. In my second example, I'm going to use somebody that's making $70,000. They don't have an option for a 401k from their employer. What can they do? They can open up a HSA or health savings account. At $70,000, you have a 22% federal tax bracket, which means you would be paying $15,400 in taxes. As a single person, you're allowed to contribute $3,650, which is tax deducted on the front end and at the back end and in the middle end, but we're going to concentrate on the front end, off of your taxes. So now it takes $70,000, I deduct $3,650, and my new taxable income is $66,350. At a 22% tax bracket, I would only be paying $14,597, which means by just investing in my HSA, I was able to save $803 in savings today from my taxes. Guys, there's tons of different strategies that allow you to mix and match to have maximum efficiency in a tax strategy. But you must plan for a tax strategy. For if you fail to plan, then you're planning to fail. And the first step of the plans is click the link down below and contact 1-800-ACCOUNTANT. Why not take advantage of a free consultation that hopefully makes you make more money, reduce your tax footprint, increase and maximize the efficiency and the financial future of not only yourself, but also your family. Make sure to call 1-800-ACCOUNTANT today and take your financial future in your own hands. Thank you so much for watching. I greatly appreciate it, and I truly hope one more time that you take advantage of a free consultation. Make sure to take advantage of that absolutely free consultation from 1-800-ACCOUNTANT and take your financial future and make sure something happens with it. Guys, I'm sorry for the long video, but I did have so much information. It is jam-packed. And at least for me, this definitely helps me make a lot of money, as I showed you just one simple example where I saved tens of thousands of dollars in just one play. Trust me, that was way over 6 figures of savings in 2021 by just doing these smart type of plays that most people have no idea about. I don't just talk about it, but I be about it. So let's bout it. Give me the likes, the shares, and subscribe, and click the links down below. Have a great day and happy trading.